From Tycoon News Studios in Delray Beach, Florida, this is Options GPS with Chris Rowe and Ron Ianieri.
Welcome back to Options GPS. I'm Chris Rowe.
And I'm Ron Ianieri.
The next thing that we're going to be talking about is a strategy called the Condor. Now, the Condor is very similar to the butterfly that you just learned. You're stretching it out a little bit. And what I like about this strategy is that you're basically doing the butterfly, but you're giving yourself a little bit more room to be wrong. You'll collect a little bit of less of a premium, and you're taking advantage of a consolidation, a sideways movement, which is usually what happens in the stock market, more than breakouts or breakdowns. And, you know, you're hedging yourself at the same time. You're giving yourself a little bit more room to be wrong. If you're like me, you're wrong every once in a while. And so that's a good thing.
One time in 1995, right?
I was wrong that time, and you remember that, clearly.
Well, you know, it's, hey, the only time you're ever wrong, how could anybody forget?
You're letting the cat out of the bag.
I'm sorry.
I was wrong in 1995
Or I'm
once.
letting the Condor out of the bag,
Okay.
as the case may be, soon.
Oh, boy.
That was terrible, huh?
Yeah. Okay, well, this is a premium collection strategy. What you want to do is you want to find a consolidation pattern. Like we said, it happens about 80% of the time in the market. And, in fact, this is a great strategy when it comes down to trading ETFs or the general market, because they don't move as erratically as a stock does.
Yep, they're not as susceptible to wild swings.
Right.
Because you're not an individual's company, you're an entire sector. You know, sectors don't report earnings. Sectors don't get taken over. And when you take away those type of wild fluctuations, then you're in a real good spot to be able to collect premium. And a lot of people every month, like clockwork, put a certain percentage of their portfolio to work in these different ETFs, these sectors, and you know, using a Condor strictly for premium collection.
Right. All the ETF Master Trader students know this. You know, when you're studying sectors, you know that sectors will break out or break down. There are like lots of little stock markets within the stock market. Obviously, we saw in the first half of 2008, energy was up, I think, 30–40%, while financials are down 30–40%. So you can't only just think about the stock market as one market, but several sectors within the market. Now, when it comes down to sectors, you know, it's easy to spot a consolidation in the sector. You know, there's nothing going on there, and stocks aren't doing anything. It's not like one of them is going to get bought out, and all of a sudden it's going to open up big, and you're going to lose your shirt in the, you know, or you know, any money since you're hedged, since you're not really losing your shirt in the Condor. But you know, when a sector does tend to break out, just like the general market, that trend tends to stay intact for a long time. So once you realize that you might be wrong for putting on the Condor, it's easy to morph and change it into another strategy.
Yeah, we have to, you know, you have to remember that when you're in the Condor, you're doing it for basically one of two reasons. One is the stock's directly in between two strikes. And if that happens, then you need to be delta neutral. You want to be delta neutral. If you did the butterfly of the lower strike or the upper strike, you'll have put on a delta. And we're trying to stay away from delta.
Right, delta
neutral. So we split the strikes. The other is we want to give more room for fluctuation. And as you said, we'll collect less premium, which is not necessarily a bad thing, but we definitely have more room for the stock just to do its normal, you know, gyrations all day long and back and forth, and without you feeling that I've got to change something now.
Right, I understood. So, like the butterfly, you know, unlike the butterfly where you want the stock to basically stay at the strike price if possible, you know, in this case, you want the stock to stay between two prices.
That's exactly right. It's giving you more of a range for the stock to finish in for you to maximize your profits.
All right. Well, with options, unlike the stock market with options, consolidation patterns are exciting because you can make money on them.
Yeah.
You know? So we're opening new doors. Consolidation is what happens most of the time, so we're going to be able to profit now most of the time instead of sitting around hoping that we get a move to the upside or the downside. We can profit from something that happens 80% of the time.
And think about Japan back in 1989, you know, when their market crashed and came into a 15-year period of almost going sideways for the entire 15 years. Think about how powerful that strategy would have been for those people, you know, with a market that just went sideways for almost half their working life.
Well, that market for you back then, that was beneficial to you because, you know, when you're 80 years old and you have a market that's, you know, just tanking or skyrocketing, it can be very hard on you.
Yeah, when you get to my age, these type of things start affecting your heart, and, you never know what day you might just go from natural causes.
Yeah, so basically what you want to do when it comes to these consolidation patterns is you want to make money. You can make a little bit at a time every single month, taking 1 or 3 or 5% every single month, and that adds up to be an enormous profit.
Compounding.
If you can do it consecutively.
Compounding. The power of compounding.
You're not going to be able to do it consecutively, but it's something that you should be able to profit from, sideways movements.
And you should always find an area to do one every month.
All right, well, why don't you show us how it's done?
You got it. Our next strategy is the Condor. And when we start with the Condor, one of the things I want you to think about is, remember when we were talking about the straddle? And we said that the straddle was supposed to be delta neutral. And with the straddle, we needed the stock to be at the strike or close in order for it to be delta neutral. We said that if the stock was in between two strikes, then the straddle wouldn't be delta neutral. And in that case, we would opt and go to the strangle, right? Because we wanted to be delta neutral. The straddle with the stock in between strikes was not delta neutral. That's when we split the strikes and we went with the strangle. In the same idea, when we have a butterfly opportunity and we look at the stock and we see the stock is directly at the strike, no problem, no brainer, butterfly. But if the stock is between two strikes, then we've got to split the strikes and we have the Condor. We had said that with the butterfly for us was going to be our short straddle, because we're not allowed to short a straddle. Not allowed to sell 2 naked options. We're not allowed to sell 1 naked option, let alone 2. So we said that if we were going to sell a straddle, not allowed to do that, we must buy the butterfly. When we talk about the strangle, instead of selling a strangle, we have to buy a Condor. So the relationship between straddle and butterfly is the same relationship from strangle to Condor. Keep that in mind. And also remember the mechanics of the butterfly. It'll be the same as the Condor. Let's take a look at the construction of our Condor. The conventional Condor is constructed by using all calls or all puts. That's just the same thing as our conventional butterfly. We're either going to have an all call Condor or we're going to have an all put Condor. Now, the construction is a little different. We're still going to buy one of the lower strike and buy one of the upper strike. In a butterfly, there would be a middle strike, 3 total strikes. The middle strike of the butterfly we would sell 2 of. Here, because we're splitting the strikes, like we would split the strikes of a straddle into a strangle, we are going to split the strikes, those middle strikes of the butterfly, we're going to split them into a Condor. So we're going to actually have 2 middle strikes, a total of 4 strikes. Long the 2 outsides, short the 2 middles. So that's where our -2 in the butterfly is going. Instead of -2 of the same strike, we're going to move one way, one the other, 2 different strikes. So we're going to set it up that way, and in a 1 to 1 to 1 to 1 ratio. Remember, all these options must be in the same month, and they must all be equidistant in strike. We still have to maintain the same equidistant spread between the strikes. So here is our long Condor construction. As you can see, to the left, we have the call Condor. We're going to be long 1 June 60 call, long 1 June 75 call. And here's our split strikes. We're going to be short 1 of the 65s and short 1 of the 70s. What we're probably going to see is the stock being right here at around 67.5. If the stock was at 65, we could have just gone with the butterfly. If the stock was here at 70, we could have just gone with the butterfly. But because the stock is in between, it would set up a situation where if we went with the 65 butterfly, we'd wind up being delta short. If we went to the 70 butterfly, we'd wind up being delta long. So what we had to do is go in between by splitting the strikes. Now we have a Condor instead of a butterfly. They're going to work the same way mechanically, but the difference is we're starting the position off the right way, delta neutral off the bat. Off on the other side, what do we have? We've got the put condor. As you can see, they're going to be, like the butterflies, call butterfly and put butterfly, synthetically equivalent. The call condor and the put condor are going to be synthetically equivalent. And we're going to take a look at that. So what we have again here is two conflicting vertical spreads. What we had in the butterfly was two spreads, a debit and a credit, both pointing and landing right at a center strike. Here, with our condor, there is no center strike because we've got two strikes. We've got a 65 and a 70. They are combined the center strike. That means instead of converging on a specific spot, the condor's convergence of its vertical spreads is in a specific area. The area defined in between the two center strikes. So instead of a conflicting vertical spreads hitting a center spot, like in the butterfly, it's going to hit a center area in the condor. With the stock between 65 and 70 is where we're going to max out on both of our spreads, thus giving the condor its maximum value in between the two strikes, unlike the butterfly, which would have its maximum value at its middle strike. So, we know that the long condors break down to two vertical spreads. A short vertical spread, which is going to be a credit spread, and a long vertical spread, which would be a debit spread. The debit and the credit hopefully are close to canceling each other out. And what we have is everything converging, these two spreads converging on their maximum value, both occurring in a specific area as defined by the two center strikes. Both verticals reach their maximum value with the stock between the two middle strikes. Butterfly has one middle strike, and that's where the butterfly is at its maximum profit potential. Condor has two center strikes. That entire area is where the condor will reach its maximum profit potential. So, with the condor having a bigger area of maximum profit, you know that that means your maximum profit will be less in the condor than it would be in the butterfly. Less risk, less reward. So here's the June 6570 condor. And what we're going to do is we're going to take a look at it, breaking it down into the two vertical spreads. So here we have long the 60, short the 65, short the 70, long the 75. Now you might say, hey Ron, is that a call condor or is that a put condor? And I'm going to sit there and respond to you, does it matter? And your answer better be, no it doesn't, Ron, because the call condor and its corresponding put condor are synthetically identical, just like they are in the butterfly, Ron. And I'm going to say, very good answer. Hey, see, you're learning already. So let's break this down into two vertical spreads. We break off the 65 and the 70, and we break off the 70 and 75. We're long the 65, we're long the 60, short the 65. If this was a call spread, this would be a long call spread, a debit trade. Then we break down the 70 and 75. If this was a call condor, then we'd be what? Short this spread. Short the 70, long the 75. We'd be short the call spread. Long the call spread, short the call spread. Debit, credit. If they were puts, it's just the opposite. We break them out again. The 60-65 would be a short put spread, which we know is identical to the corresponding long call spread, right? So the short put spread, long call spread, it's the same thing. So even the individual spreads in the condor of two synthetically equivalent condors are equivalent. So we've got that. Then we have this one. What is that? That's going to be a long put spread. Long the 75 put, short the 70 put. That is a long put spread, which we know synthetically is the short call spread, so they match up. Even the individual spreads match up synthetically from the put Condor to the call Condor. So what are we doing here? This is a very powerful premium collection strategy, but the key is it's fully hedged. If we want to sell a strangle, it would mean that we would be getting naked short two options, two short options with unlimited potential loss and no hedge to them. That's unacceptable. So we know we can't sell the strangle naked. So what do? We put a hedge around the strangle. Just like we knew we couldn't sell the straddle naked, we put a hedge around the straddle and we created a long butterfly. Here, when we're going to sell a strangle, we can't sell the strangle naked. We need a hedge around it. And when we put that hedge around it, in the same way we did with the butterfly, when we put the hedge around it, we take our short strangle and turn it into a long condor. And that is now a fully hedged position. Now we can collect premium and be fully hedged. That is key. Normally these things are delta neutral. Remember, we're trading a consolidation. The consolidation means that we've got little to no movement. We'll have inner fluctuation back and forth, but we're looking at a sideways trend. If we're expecting that, then we aren't expecting the stock to go up. We're not expecting the stock to go down. So let's eliminate the delta because we're not trying to use it. And if we don't want to use the delta to our advantage, then let's not have one because it could also go to our disadvantage. Let's neutralize it and get it out of the way and get to the real functionality of this strategy, which is premium collection. Delta neutral. That's why we use a condor instead of a butterfly. Because we do a butterfly and it's not delta neutral because the stock's between two strikes, we just simply flip over and say, you know what? The butterfly is going to give me a delta because of where the stock is. Let me look at the condor. Boom, the condor is a delta neutral. We do the condor. It's not only excellent for use in consolidations, it's pretty much what you want to do for consolidations. It's also an income generator. There's a low risk. There's a reasonable reward. It's not an expensive strategy to get into, and you're getting a good amount out of. And it's something that can be done on a month-to-month basis. It can also be used to trade volatility skews. We talked about that with the butterfly. We know that there's a volatility smile. And we understand that sometimes that smile gets too flat. Sometimes that smile gets too peaked. And if we understand volatility, we know about mean reversion. We know that if that smile gets too peaked, it's going to have to flatten out. And if it gets too flat, it's going to have to peak a bit. We can use the condor to trade the movement of the smile. Not the movement of overall volatility, just the movement of the smile, which means the relationship between the volatility levels of different options in the same month. Profit and loss, break even. Well, think back to your break even of your butterfly. We went to that low strike and we added the cost of the butterfly. We went to the high strike and subtracted the cost of the butterfly. We're going to do the same thing here with our condor. We're going to go to the low strike and add the value of the condor. We're going to go to our high strike and subtract the value of our condor. Point of maximum profit. Well, we kind of already hit into this. Remember, we have two short options. And if we're looking at a strategy that has short options and long options, we always want the stock to go to the short options. We want it away from the long options. Our point of maximum profit here is where the short options are. Now, the difference between the condor and the butterfly is those two short options. In the butterfly, the two short options are of the same strike. We want the stock to finish right on the strike. But in the condor, the two short options are separated. And because of that, with the condor, we want the stock to finish in between those two short strikes, anywhere in between. Anywhere from 65 to 70. That's what we want. So the maximum value of a condor is the difference between the strikes. Remember, the maximum value of the butterfly was the difference between two strikes. We have two vertical spreads. One of them will be worth something, the other won't. We have to remember that the maximum value of one of them is the biggest that the Condor could ever see. The minimum value of one of them is the lowest value the Condor could ever see. And the lowest value we know will be at the long strikes. The highest value will be at the two middle strikes and in between. So what we're looking at here is a maximum value of $5 in a Condor that's $5 between strikes. So our point of maximum profit is the area between the two short strikes. And for someone who is buying this Condor, who's doing the premium collection, if the stock finishes between the two short strikes, you'll have hit your maximum reward. Now, your maximum loss, pretty obvious. We know that whenever you're long options, the last place you want the stock to finish at expiration is directly on your long strike. Our point of maximum loss is directly on either of the two long strikes and above on the higher strike and below on the lower. Simple as that. So if we have that 60, 65, 70, 75 Condor, our point of maximum loss will be 75 and above or 60 and below. Either one of those two areas throws us with our maximum loss, because at 75 and above, one of our spreads will hit its maximum value against us. The other 60 and below, that other spread then hits its maximum value of $5 against us. If we brought in $1 on the Condor, if we spent $1, we know what we can lose. We know where we can lose it. If we spent $2, we know exactly what we can lose and where we can lose it. The Condor is a limited risk, limited profit position. We know that ahead of time, and we can calculate that very easily. So the stock price, where's the stock going to be at our point of maximum loss? On our long strikes. 60 and below, 75 and above. Where do we make our maximum profit? Between the two middle strikes, between 65 and 70. Remember, maximum value of the Condor, $5. Minimum value of the Condor, 0. So here's the chart of our long Condor. How would it be different between the long Condor and the long butterfly? Easy. Because the long butterfly only has one strike and dead in the center, these two lines would continue up into a triangle and converge right here. That would be what we would see in a butterfly. But because the Condor splits those two strikes, our maximum profit is anywhere between those two middle strikes. Here's our 65 strike. We're at point of maximum profit. Here's our 70 strike, point of maximum profit. Look at our break-evens. As you can see, our break-evens are inside of our two outer strikes. Here's our 60 strike. Here's our 75 strike. The break-evens are inside of those two outer strikes. If we take a look, how much inside? If this is 60 and here's our break-even, where is that break-even point? 60 plus the cost of the Condor takes us above 60, which puts us inside this strike. 75 minus the cost of the Condor puts us inside the strike. That's how we calculate our two break-evens. Lower strike minus Condor price, upper strike minus Condor price. This whole area is profit. Out here beyond the break-evens, we're at losses. But once we hit that upper strike, or once we hit that lower strike, we are at points of maximum loss. Doesn't matter how much further it goes. We're at maximum loss. We can't lose any more no matter where the stock goes. Limited risk, limited reward. Well, let's take a look at our Greeks here. Now, as you recall, when I was talking about the butterfly, I said, don't get crazy about the Greeks. Know them, but they're not quite as important when we're dealing with a limited risk, limited reward strategy. Remember, the Greeks are there to help us define our risks. When the risks are open-ended, then the Greeks are obviously much more important. But here, we don't have open-ended risks. We don't have open-ended reward. We don't have open-ended risks. We have a limited reward and a limited risk. It's fixed and known ahead of time. We also know where we break even and where we lose the most we can. Fixed and set ahead of time. Suddenly, the Greeks, although critically important in option trading, and you're never going to get me to say that they're not important. Never. But they're least important when we have all of our risks and all of our rewards dollar defined at exact price points, and we're in a position that has a limited risk, limited reward, like the butterfly and like the condor. So we're going to be delta neutral. We're going to be short gamma. We're short the two strikes that are closest to the stock. That makes those two strikes kind of the at-the-moneys. Those two will have the biggest gamma. And since we're short both of them, that short gamma of those two is going to outperform the long gamma of my outer strikes, which are further away from the stock and thus have a smaller gamma. Theta, well, we know we're long. This is a premium collection strategy. We're going to be collecting theta. We're going to be collecting the decay of this position. Vega, we're also short because in any given month, Vega is highest at the money. Same situation with the gamma, same situation with the theta. We're always highest at the money. Our two at the money options are both short options. They are definitely going to give us a bigger short Vega than our two long options that are further away from the money will give us long Vega. So more short, less long, it's going to give us an overall short Vega position. Let's talk about the synthetics of the Condor. Well, the long call Condor equals the long put Condor. That's the same thing as the butterfly. These two positions are synthetically identical. We also know that the short call Condor equals the short put Condor. How come I don't ever do a short call Condor and a short put Condor? Because those two positions feature long the at-the-money strikes. They feature an outlay of premium. I am paying decay. If I have a position that's going to be hurt by a lack of movement, then the last thing I want to do is limit my abilities to make money on real movement. I have a very small chance of making money, we said, when we're long the straddle or long the strangle, because the stock has to move so doggone much for me to really make money. If I'm going to take that risk, the last thing I want to do is limit my potential that if the stock really does explode, which I'm praying to God it does, then I've limited the amount of money I can make. Why am I going to buy the two center options and then sell one up and sell one down, limiting my profitability? I'm buying a straddle, I'm buying a strangle because I'm hitting for the fences. I'm swinging for the fences. I'm going to try to drive the ball out of the park. If I'm going to do that, I'm not going to try to bunt. I got to swing. I don't want to be limited. And that's why instead of doing a short call Condor or a short put Condor, I just buy the straddle or buy the strangle outright. Why limit myself on a position that has a small chance of winning, that needs dramatic movement in the stock? Why am I going to sit there and limit my ability to really profit if I get lucky enough on the odd chance that I do get that explosive movement? I wouldn't. That's why I don't do those. Now, should I not teach them? Probably. Because I think if I teach them, people start using them. This, for an individual investor, is a waste of time. If you're going to really want to try to make money on a straddle or strangle, then you're going to have to really collect big on the times you hit it big. You can't limit yourself, because there's going to be enough times that you do the long straddle and long strangle and lose. You've got to make up for them. So if you're going to make up for it, you have to make sure that on the day you get that gigantic, crazy movement, you don't limit yourself to your profit potential in a position that stands little chance to make money to begin with, and is going to cost you a few bucks if you're wrong. We want to hit the home run on those. That's why I don't use the short condors, because I don't want to limit myself when I'm swinging for the fences. Now, the long condor, both call and put, are going to be synthetically identical to the short iron condor, just like we talked about in our butterflies. I showed you how the long butterfly call and the long butterfly put were synthetically equivalent. Then I showed you how they were synthetically equivalent to the short iron butterfly. Here in the condor, the same thing is happening. My long call condor is synthetically identical to my long put condor. And the two of them are synthetically equivalent to their corresponding short iron condor. These are long not because they're premium outlay. We know they're premium collection. These are called long because we have to pay a debit. Still a premium collector, but a debit. This is short because we're actually getting a credit for it due to the construction difference. Because we're getting a credit, it's short. Don't confuse the fact that because this is a debit, it's not premium collection. It is. And don't ever confuse the fact that just because this is a credit, it's got to be a premium collector. That's not true. In this case, it is. This is a premium collection strategy that we could set up like a credit or like a debit. Which one should we do? Got to price them out to see if there's a price discrepancy. With no price discrepancy, do the one you want to do. If there is a price discrepancy, do the one that's cheaper on the way in and do the one that's more expensive on the way out. Why? Because if the long condor, the call and the put, synthetically equivalent, and the short iron condor, synthetically equivalent, whatever shuts down one of them has to shut down the rest because they're all the same thing. So I can use either one, any of the three actually, to initiate the position, and then I can use any of the three to close down what I have existing. I can use the short condor to close the long condor. Call or put. I can have a long call condor, shut it down with a short call condor. I can have a long put condor, shut it down with a short call condor. I can have a short iron condor that I can shut down with a short call condor. Being that all three are equal, whatever shuts down one, shuts down the others. So our short condor, call and put, would be synthetically equivalent to the long iron condor. Again, I don't want to do these trades. Personally, if I'm going to be swinging for the fences and I'm going to take big risk, I want big reward. I don't want to throw on two out-of-the-money short options that limit my potential big gain when I spent big money and took big risk. If I take a big risk and I put out big money, I have to justify it with a position that will give me a big reward if I'm right. This won't. This says, hey, take big risk, put out big money, and maybe don't get a big return. No. If I'm going to be right on these positions, I have to have the big return to justify the risks and the capital outlay that I put forth. Now, obviously, because the condor is a combination of two vertical spreads, we know that each of those vertical spreads is a component of its own box. That means either side of the condor, either spread, can be shut down via the box. Keep that in mind. So each vertical spread is half of a box. Now, obviously I made some statements saying that the call condor is synthetically equivalent to its put condor. And because I proved the math to you in the butterfly, and I know that in the course of your review, you went and did a couple on those sheets we provided you yourself, and you came up to the same conclusions a few times, you obviously already know that this math is going to work out. But you know what? We're going to go through it once anyway, because I want to go through it with you so that way when you have time to practice a few, you do it right and you come up with the conclusions you're supposed to. Remember, I'm not telling you you've got to do 500 of these things. I'm telling you you should do 3, 4, 5. And maybe once a month, once every couple weeks, a couple times. So let's take a look at our June 65 call condor. Straight off your sheets. Sheet number 1, June, with the stock at 67.50, right? Because we wouldn't have done this condor if the stock was directly on the 65 strike or directly on the 70 strike. We'd only do it if the stock is in between the two strikes. So these figures must be from a stock price of 67.50, which they are. So, June 60 call with the stock at 67.50, $7.62. We're going to buy one of them. June 65 calls, $3.34. We're selling one of them. June 70 call, 87 cents. We're selling one of them. And June 75 call, 12 cents. We're going to buy one of them. Now, when we add up all these, 60 and 75 get added together, then subtract the 65 and 70. We come up with a debit. Why is it a debit? Because we're buying this deep in the money option. That's why it's a debit. We come up with a $3.53 debit. Now, we know the maximum value of this condor. How far between each strike? $5. This condor's total value, the maximum value, the highest it can trade, is $5. We paid $3.53 for it. If it can go to 5 and we paid $3.53, then our total maximum potential profit is $1.47. Now, think of this in the scheme of things. We have this position on for 8 days. 18 days. That's the days to expiration of your sheets. In 18 days, if the stock stays between 65 and 70, we make $1.47 on a $3.53 investment in 18 days. That's a decent percentage return for a year, let alone less than a month. Now, over here, our put condor. If our call condor is truly synthetically equivalent to our put condor, these numbers ought to be the same. June 60 put, 6 cents. Remember, stock price 67.5. June 65 puts, 77 cents. We're selling one of those. We bought the June 60 put. We sold the June 65 put. June 70 put, 331. We sold one of those. June 75 put, 757. We bought one of those. Total debit, $3.55. Maximum profit, $1.45. Got a little rounding error in there, obviously. Our sheets only go to 2 decimal points. But the fact of the matter is look at that. They match. They have to. They're synthetically equivalent. They have to match. Now, how does the condor work? Simple. Theta. That's how condor works. Theta. Say it with me. Theta. This position is all about premium collection. And we being well versed in the Greeks by now, right? We understand what premium collection means. It means theta. We are taking advantage of the theta of our options. We have a higher theta in the short options than we have in our long options. We have more decay in the at-the-money short options than we have in our out-of-the-money long options. That means that we're going to be receiving daily income through the passage of time, all things being equal. So our real gig here is to find a stock that's going sideways, put on our Condor, and let the time go by. That is the key. The longer we can stay in that Condor and hold off, the more money we collect. Why is that? Because we know the basic behavior of theta. We know that time decay is nonlinear. The closer we get to expiration, the more rapid the decay. The longer we can hold this position, the closer we can push into expiration, the more money we make. And as days go by and we get closer and closer to expiration, the more and more money we make, because the options continue to decay at an increasing rate. So that is what we're doing when we throw the Condor on. That's what we're trying to take advantage of. Now, do understand that sometimes people don't just throw a Condor on. They leg into the Condor via another position. In this case, normally, it is a vertical spread. We know the Condor is built of two conflicting vertical spreads. And since it's built of two vertical spreads, we could have put one vertical spread on earlier to take advantage of a stock movement. Once the movement is ended and we start seeing a consolidation pattern, we could then throw the other vertical spread on, now taking us from a directional trade that is collecting a little premium, the vertical spread, if constructed properly. And now we turn that into a Condor, which is a delta neutral premium collector, making money in the sideways pattern. Quite often stocks that run up will either retrace back a bit before developing their new trading range, or they'll start going sideways immediately and consolidating. That happens up at the top of charts. It happens at the bottom of charts. If you're in a vertical spread and you notice the stock is now turned sideways and starting to consolidate, you could leg right into the Condor by understanding the construction and throwing on your conflicting vertical spread. When are we using this thing? Well, obviously, we're using this in times of consolidation, sideways trading pattern. We want to make sure we know that. But here's the thing. If we're thinking about a position like the butterfly or Condor, and the stock is between the two strikes, that's when we use the Condor. Why? Because we have the opportunity to go into the trade as a whole and be delta neutral immediately. If we selected one butterfly, the lower strike butterfly, or the upper strike butterfly, we're going to acquire a delta. Could be long, could be short, depending on which strike we choose. But either way, it's a delta. It's unwanted. We need to be able to not have that delta. How do we do it? When the stock is between the strikes, we split the strikes. We go from butterfly to Condor. In a sense, the Condor is a split strike butterfly. In the same way that a strangle is a split strike straddle. Obviously, stagnation is key to this trade. Now, another time that you might want to use the butterfly, or excuse me, the Condor over the butterfly. You're looking at it and you say, hey, I want to do a butterfly. And you say, you know what? This stock fluctuates a lot. I mean, it's in a trading range, but the trading range is pretty big and it's pretty volatile. And it makes me nervous. I mean, I know that as long as it stays in the range, my butterfly is going to work out for me. But it's kind of scary. I'm not ready. My stomach's not ready. My psyche's not ready to deal with the fluctuations of this stock using a butterfly. So what can I do? Split it anyway. Move my two vertical spreads. Move one, the one that's lower, and move the other that's higher. Purposely break those spreads equidistant in either direction away from the stock. We're not just doing it because the stock is in between two strikes. We could do it because we just want to move away from that at-the-money single option because we want a little more leeway for movement. Now, is it mathematically smart? Probably not. It probably won't be mathematically smart. But you know what? All the math in the world doesn't help your stomach, and it doesn't help your head. If you're not going to think straight because you're feeling too much pressure, you've got risk up to here, and you're worried, and you can't tolerate, you're not going to make right decisions. Don't use the butterfly in that case, even if the stock is at the strike. Go to the strangle and spread out a little more. Remember in that chart of the strangle, remember how that was flattened out from the straddle. Here, the condor and the butterfly have the same relationship. Remember the butterfly had that point it came to, and it maxed out only right at the point. The strangle maxed out flat across the distance between the 2 points. Use that idea. Spread your strikes out. Give the stock more room to wiggle. This way you could be a lot calmer, and the stock normal fluctuation doesn't throw your P&L back and forth and around, making you a nervous wreck. Split the strikes. Take a little less risk. Do understand there'll be less reward here. But you know what? If you're going to be able to stay calm and make the right decisions, I'd rather see you take a little less reward, a little more often, in a little calmer fashion, than to try to get that extra reward of the butterfly and not think straight, not sleep at night, not eat, get thrown out of the house by your wife, have your dogs biting you. We don't need that. Some of trading is a little about psyche, especially for you just beginning. Me, my psyche's gone. Doesn't matter. Win, lose, I play the next game because I've done it a million times. For you at the beginning, trading your own money, feeling the burden of trying to make up for what your fund manager lost you, I'd rather you be in a good frame of mind, have a little less risk, spread the strike out, and make a little less until you get to that point where you could say, like I just did, I have no psyche, it doesn't matter, I win, I lose, I move on. When that time comes, then I'll yell at you for not being in the butterfly when you should have been. But if you have to take the strangle because you want to give the stock a little more room before you feel the pressure, by all means, please do. It's the smart move. Now, we know the volatility smile can be skewed. And we said that the butterfly can take advantage of it. Because the butterfly would put me in a position where I could be short the at-the-monies and long the wings, or I could be long the at-the-monies and short the wings, which will play on the opening and closing of the smile. I can do the same thing in the Condor. If the stock is between two strikes and I want to play that flapping of the wings, then I just use the Condor. Because remember, if I'm trying to trade movements of the volatility smile, flat to peaked, to peaked to flat to mean, if I'm trying to play that, am I trying to play delta? Am I trying to play stock direction? No, I'm not. If I'm not trying to play it, let's eliminate it. Yeah, might I have gotten a pleasant surprise? Yeah. But are the odds in favor of you getting a pleasant surprise? No. So let's just eliminate it. Let's go delta neutral. And let's go with the Condor to trade our smile if the stock is between the two strikes. At the strike, butterfly. Between the strikes, Condor to play the volatility smile.